Hey, good afternoon, Antonio. Hello. Antonio, I think your microphone is off. Or, yeah, hi. Um, you can hear, oh yeah, your mic is off. Okay, I see only you. Yeah, you need to probably adjust your setting. I see only you. Let me check the forum. Yeah, two people at least. Aura is here, just waiting for her to join. Uh, let me give a couple of minutes for people uh, to fully join.
Hello?
Yeah, how are you?
Hi,
How
how
are
are
you,
you?
Antonio? Yeah,
I'm
your
is it
microphone is
working?
back, right?
Oh yes, it's working now, right?
Yeah,
All
it's
right.
working. It seems like working perfectly. All righty. I don't see any other people. I mean, I saw Aura in today's discussion board, so hopefully she is going to join in a few minutes. And Chris is joining. I think
Yes,
he
he's
has
already
just
here.
joined. Let me give a couple of more minutes for the rest of the. And I think Jacob is joining too. Okay. Hey, good morning, everyone. So well, let's give a couple of more minutes. But while we are waiting for the rest of the class, let me just, uh, okay, I don't see, yeah, Chris is there. And Jacob, please also sign into the discussion board, right? Jacob, if you're there, right? Sign into the discussion board. And that's the only way.
I just did. I just did.
Oh, you did? Okay, all righty. Let me just, all righty. Yeah, you did. So also let me point out, so everyone knows that our last day of class is next Monday, right? And it's a face-to-face day. So we'll be in the we'll meet in Maury 1007 Maury building. But again, the final instruction was also issued. So of course, final will be done before our last class. Um, so you can think about it. Some people are asking me, do I have to come on that day? Uh, well, if you have had a perfect attendance so far, you're entitled. I mean, you're entitled to at least 1 day off. Um, but if you don't have perfect attendance, I think uh, attendance matters, right? Attendance matters. I don't know if I have shared. Let me see. Do I have the latest? Okay, the latest. I don't think it's the latest, but okay, this is not the latest one. But anyway, this is what you will find as of yes, if you go to the assignments here, quiz 1 midterm quiz results with attendance as of 11/24. 1124 was before Thanksgiving. That was before Thanksgiving. So you must have, that was. So then since then, there has been some, slight changes to, basically the test results, no change, but the attendance, right? Attendance. There will be additional information about attendance. So, and the on our last day, by then everything will be covered. Oh, okay, this way you can see that. But I want you to read this. This is the reading for our last day. So read it in advance. It's a very interesting topic. Article. I mean, it's a paper written by Warren Buffett. Actually, it's his lecture at Columbia. I mean, Warren Buffett is a Columbia alumni. So he gave a lecture, a special, lecture one day at his alma mater. And that was 1984. I mean, 1984, he was probably, how old is Warren Buffett? Probably he's in his 80s. If he's in his 80s, 1984, that was like, 40 years ago. He was still in his 40s. So he was already, noticed. I mean, he made his marks even then. So, and the title of his lecture was, Super Investors of Graham and Doddsville. And this is basically, what sets the tone for his investment style and his, strategy. And then it's not visible here, but because it will open only on that day. But okay, if you exit preview. Okay. If you exit preview, you will see, and also I must be out of preview. Yeah. Oops, it's not. Why is it? Not sure why it isn't there, but I'll take care of it. There are some videos about the. I don't know why it's not here. It must be. Still farther section. Okay, I'll put this there. I'll put it. It's not showing. There's no reason. All right. And then even today, let's see. Today's forum. Okay, I got a good number of people. I should be there. Oh, okay. Maybe it's not there today, but Wednesday. Okay, it's there. So Yeah, I just need to copy that. Okay, I'll talk about that later. All right, so in our last class we talked about the tips, right? How they make adjustment for inflation. Um, if we briefly go over that again, no, I'm not going to go over that again because it was discussed, uh, let me just check your understanding. So, let me. All righty. So in the last class, I already talked about um, what year is the base year for CPI, right? I already talked about that. When the base year for CPI is 1982 through 1984, right? For and I explained why, because that was so that was the time when in the U.S. economy, the right after following the stagflation of the 1970s, um, they implemented as the Reagan administration came in 1980, they implemented, actually it's the Federal Reserve, but Ronald Reagan appointed Paul Volcker as the uh, chairman of the Federal Reserve. And Paul Volcker died. I think he died actually. I mean, he died in 1990. I'm sorry, 2019 or 2020. He died just recently. Um, and because uh, prior to 1980s, I don't even remember the names of the federal Fed chairman, but from Paul Volcker. So as far as I have memory, I mean, or consciousness, as far as I have the consciousness about the macroeconomic policy, um, the first Federal Reserve chair that I remember as a college student, right? And since then, as a was Paul Volcker, right? Because in the 70s I was a teenager, and as a teenager uh, I wouldn't even bother to know who was the Federal Reserve chair. uh, but then the first, it's like you can't erase that kind of memory because the first president in my life that I knew in my life was JFK, and then after that it was Lyndon B. Johnson. I mean, if I was born in the 50s, I probably remember Harry Truman as the first president in my life, or Dwight D. Eisenhower as the first president in my. But people who were born in the 70s probably remember Richard Nixon as the first president, as their first president in their lives. But so being in my 20s in the 1980s, I remember Paul Volcker as the first Federal Reserve chair. And then, so Paul Volcker came in and implemented um, tight monetary policy to curb the inflation. So they did. And when you tight monetary policy means you are raising interest rate. So as you raise the interest rate, then the economy goes into recession. So they hit the bottom of the recession in 82. So that's why 82 through 84 was the recession period of recession. That's why they use this as the base year for CPI. Okay, that means base year CPI is always the base year CPI is 100. Okay, so then the following years, later years, the CPI would have to go up because if the economy grows, right, CPI would have to go up. If the CPIs go down below 100, that means the economy worsened even since the base year. Now, of course, some people say, 1982 is almost 40 years ago. It's 40 years ago. How much impact does it have on, wouldn't it be too remote to relate it to today's economy? Yeah, there's some distance, problem, remoteness. So another second base year point is 1997. Second base year point. Why 1997? Because in 1997 there was an event called Black Monday. Black Monday. It sounds like Black Friday, so it's like a shopping spree. It sounds like no, it's not a shopping spree. Black Monday, if I remember correctly, in '97, it was a Monday in September. 1 September on Monday, the stock market crashed. Of course, it wasn't a complete crash like 1929, but the stock market had a big crash on that day, and that started a recession for a brief, was relatively like for 2 years. 1 year, relatively 1 year. So that is the another base point, another base year in the recent U.S. history. So 97 is the base year, and so in our example, in that example we used last time, in that example, base year was 97. So the CPI of 97 was 100, right? And then I think we did this, didn't we? If between 97 and 2007, that is 10 years, right? That's 10 years. Over 10 years, right? And then CPI of 2007 was, 10 years later, 201. And simply let's just approximate it as 200, approximating it as 200. What is the inflation between 97 and 2007? Anybody? What is the inflation rate between those, 10 years, over those 10 years? What is the, anyone? I think we talked about this last time. Can anyone just roughly, think of it as, I would put it here. Anyone? How come? How come it's very quiet? Huh? I'll ask. So I have Antonio here. Only like how many people? Only 6 people. This is a disaster. We have like how many people are here today? In the discussion board, I have 8 people. Okay. So if I have 6, I think that's decent. It's not that bad. Antonio, you're there, I
Yes.
know. Yeah,
So,
Antonio. So yeah. So what do you think? Uh, what was the inflation between 97 and 2007? Hmm?
mm,
The CPI of 97 was 100. The CPI of 2007 was 201. So what was the inflation over these 10 years?
would it be 200%?
No. Uh, you can. Uh, Let me ask again. Net inflation, net.
Mm. I'm confused, honestly.
Look, think about it. Um, from 100 to 200, what's the growth rate?
2%.
Well, how can it be
Oh
2%
wait,
from 100 to 200? If your salary was $100, right, in 97, and your salary grew to $200, so how much is the growth rate of your
uh,
salary?
yeah, the growth would be 200%
Why is it 200%?
because from 100 to 200, that's 200% of 100 would be 200.
That's growth. Yeah, it can be 200% if you're talking about the gross growth rate, right? But people, but in net growth rate, think about it. When it's double, your salary doubled, right? But when the salary doubles, the growth portion is only what? If anything doubles, the
Only
growth is
100?
100%, of course.
100.
That's the net, right?
Right,
We're
right, right.
talking about the net growth rate, right? Uh, so yeah, we can tell, oh, the price level, inflation over 10 years was 100%. Then and then 2007 through 2010, right? Um, that's like 3 years, right? The CPI was 201, but just approximated, roughly approximated as 200. So between 2000 and 2010, 7 and 2010, um, when the CPI grew from 200 to 216, what's the inflation? Mhm. What's the growth rate of the price level?
I understand now.
Hmm? You
I
understand now.
understand.
So
Yeah.
then what's the inflation?
So wait, what would be the formula for that?
Well, so you need to figure it out. If I give you the formula, then I'm giving you the answer. But look, just like when um, price level was jumped from 100 to 200, and that's 100%. Then if it jumped from grew from 200 to 216, how would you find the hmm?
trying to calculate it right now.
Okay, and while you're at it, let me ask someone else. Aura, are you there, Aura? Aura?
Yeah, I'm here, but I'm
Yeah,
kind of in a space. I don't know if you can hear me.
yeah, I can hear you. I hear you.
Okay, I'm
Yeah.
sorry. I was walking, so I couldn't answer. So what's the question again?
Oh, come on. The question was, um, between 2000 and 2010, the
Mm-hmm.
CPI grew from 200, roughly approximated as 200, from 200 to 216. It grew from 200 to 216, right? And what's the
Mm-hmm.
inflation? Hmm?
The inflation, like I would say, 16%,
No. Think again.
1.6.
No, 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 no. 1.6. Where did that 1 point? That's just groundless. How about Chris? Chris, are you there, Chris? Hmm? Chris, how
Would
about
it
you,
be
George?
roughly 7.5%?
Oh, well, yeah, yeah, you got it right. I mean, roughly, but if you did it roughly, that would be rather like 8%, right?
Yeah,
Why?
roughly 8%. Yeah.
Yeah, because if you used if you used approximation of 200, okay, so you got that right. So I'm gonna give you Antonio. You got 0.25. You're getting 0.25 for that. Yes, think about it. What is the growth rate? How do you find the growth rate? It's simple. Um, Basically, uh, originally it was 200, right? Right? From 200, it grew to 216. So the change is 16, right? You divide it by what was the original, 200. So then what do you get? That would be exactly 16 over 200, right? That would be 8%, right? And that's inflation is the growth rate of the price level. So it's not any growth rate. There is any growth rate. All the growth is basically calculated this way. It will be 8%. Of course, if you are, doing it exactly, then 216 minus 201. But just to make it easier, right? So this is how you find, right? This is how you find growth rate or inflation. Okay, my Fitbit was alerting me that I needed to stretch. um, so I need to stretch. Give me a whole day, I'm this sedentary lifestyle. It's a very dangerous lifestyle, a sedentary lifestyle. Uh, no exercise, sitting all the time. So not only my Fitbit is telling me, if I'm not taking a walk, I need to make at least 10,000 steps a day. But if I'm not even anywhere near that, then at least I should be stretching. So I can stretch. Okay. All right, then we got the concept of inflation. So, but the exact number would be um, based on this, the exact number was in 2007 it was 201. Okay, and then in 2010 it was 201.66, and 2010 216.24 or 25. So if you actually calculate it, it will come to 0.0723 or 7.23%. Okay, 7.23%. So think about it. If the TIPS, the Treasury Inflation Protected Security, right, which is Treasury bond that is compensated, protected against, or compensated for inflation, the price will have the par value, the face value of the Treasury will have to be adjusted by inflation. So par value is 1,000. So you multiply it by 1.0723, the par value of 1,000, face value 1,000 will be adjusted by 1.07231. So the face value will be, of course, on the bond it will say 1,000, but you will get the face value will be 1,072.31, and then the coupon interest will be, the coupon interest is 2.375% of this, right? And the coupon interest was given here, given as 2 3/8%, and this is, I told you about this. This is a peculiar way that the Treasury is being quoted, right? I've been telling you that Treasury uses 30-second system, right? 30-second is 30, like 25 over 32. I mean, it can be like eighth, something over eighth as well. So if you translate that, convert it into a regular percentage, it's going to be 2.375. So then the coupon amount will be simply 2.375% of this face value, right? So annual coupon will be 1.072, right? Times 3.1, then times 0.023 something, and then it comes to a 25.47, right? That's the annual coupon. But then you how many times do the bonds pay interest?
It's semi-annual.
It's semi-annual. Yes, you're right. And who was this? Who was
Aura.
this? Who said that? Oh, okay, Aura. So yeah, Aura, you'll get 0.25. Okay, 0.25. Antonio, you gave me that, actually for that you got 0.5, not 0.25. You gave me that the inflation between over 3 years, right? Yeah, because it is, bonds are paying interest, semi-annually, right? So every 6 months, and half your coupon interest will be simply this 20 annual coupon divided by 2. So they come to 12.73. Okay. So that's what, TIPS is, So this is almost not a big, not a big deal, It's just even the 7th grader can do this. It's just making adjustment for inflation. Okay. Now, so that's the end of, we had already talked about, municipal bonds. So we're done with it. So we are pretty much done with all the institutional aspect of the bond. So we are now moving on to the valuation part, so mathematical part of the bond. We know there are zero coupon bonds and coupon bonds. Zero coupon bond is quite easy because zero coupon bonds will always end up at maturity. It will always end up with in $1,000, right? It will always end up in $1,000. So it's going to be that's the future value. So all you need to do is discount because there's no interest paid during. It's a single cash flow model, right? You just need to discount it to find the present value. But here, so a bond with par value of 1,000, maturing in 20 years, and price to yield 6%. Now, this is the way. What this means is price to yield. That means this is the discount rate. This is the discount rate. That's what it means. Okay. So they never say straightforward, use this as the discount rate. Okay. But there are typically like three ways it is worded. Three ways it is worded. One way is the bond is priced to yield 6%. Okay. And second way is the comparable bonds or the similar bonds, comparable bonds or similar bonds pay 6%. What that means is, comparable means the bonds of the same risk class, the bonds of the similar risk class. Okay. The bonds have, AAA, the risk categories, right? Credit ratings, AAA, AA, single A, triple B, double B, single B, triple C. And I've been telling you, triple B and above, only triple B and above are investment grade, and all these different credit ratings will mean different different risks, right? Different risks. So AAA is of course highest, so the safest, right? And then below triple B are considered risky. Okay. Of course, you can buy bonds, high risk bonds with below triple B classes, but then that means you are willing to take a risk. And if you're willing to take a risk, then rather, why, if there is so much risk, why not, why not investing your money in the stocks rather than in bonds, right? So if the bond is already something like, single B or below single B, then it's already like as risky as stock. And now, and the third way it is worded is that the prevailing third way it is worded, prevailing market rate, prevailing rate in the market is 6%, prevailing rate. So that prevailing rate means actually the bonds, a prevailing rate for the bonds in that category, in that risk category. So there are three ways. They never tell you straightforward that 6% is the discount rate. There's no way it is worded that way. Okay, so you have to remember that. That means this is the interest rate or the discount rate. Oh, then you can say, oh, then it's easy. Then all I need to do is discount this 1,000 by 1.06 raised to 20. Yes, but that's not that's not perfect. That's not Why? That's not 100% correct. Why? Think about it. Bonds, Aura already got this, answered this. Bonds are on semi-annual cycle, right? Um, so bonds are on semi-annual cycle. So so N is 2. M is 2. Compounding frequency is 2. Okay, so you don't. It's not going to be discounting by 1.06 raised to 20, but it's going to be 1.03 raised to 40. That's why you might wonder, oh, why is it 40? Why is the N 40? And why is the R 0.03? Well, M is 2, so periodic rate will be half 6%, right? And M will be N will be 40. So if you do that, 306.56. And again, this is the fair value or rational price or intrinsic value, right? That's the price that it should be if the market is rational. But I've been telling you the market is, in the short run, often irrational in the short run. That's why it says it might be purchased for about, right? 306. Why? Because in reality, in the short run, market is not rational. So the market price could be slightly above or slightly below this. Okay, and what is that margin of that slight difference? Margin of the slight difference, it could be $2. It could be $1.50. I mean, it won't be that outlandishly different. It won't be outlandishly different, but a few dollars difference. Okay, it could be overpriced or underpriced. Okay, but then so it's easy. But how about the coupon bond? We already know if it is the coupon bond. Suppose this one is a 10%. A bond that's 10 years to maturity, par value of 1,000, coupon rate of 10%. Then we know coupons are 100. At the end of each year for 10 years, you'll get $100 coupons every year, and we're assuming annual coupon. In reality, this will have to be semi-annual, and on the timeline there will be 20 notches on the timeline. But assuming just annual coupons, then at the end of each year there will be 100, 100, 100, 100. There will be 10 of them, right? 10 constant payment at regular interval. So what is that called? If you are paying or receiving regular amount at regular interval, there is a name for such a cash flow, right? Isn't that annuity? Isn't it annuity? That's exactly annuity, because that's why we talked about annuity before coming to bond, right? You should know how to calculate the present value of annuity, right, to price the bond. So with $100, annuity. So and then at the end of year 10, we have the face value or the maturity value of 1,000. So bond valuation consists of two components, two types of cash flows. One, annuity, right? So we need present value of annuities and a present value of single cash flow, because this $1,000 is at the end of the 10-year timeline. So what we need to do is, combine the present values of these two types of cash flows, right? So we already know. Oh, then the present value of the bond, right? So it's the combination of present value of annuities and present value of the face value, 1,000. So if you combine those two formulas, right? This is sum of all the which is annuities. So this is the present value of annuity formula, right? Coupon over R minus coupon over R times 1 plus R raised to T, right? Terminal time. And then this is the single cash flow, present value of single cash flow, right? This way we can easily do, Excel has also a price function built into it. We can use price function, but to use price function, all the prices must be expressed as percentage of the par value, right? So in other words, the par value will be expressed as 100. That doesn't mean $100. You should know it means 100%. Okay, we need also today's date, settlement date, and maturity date. I'm going to talk about that later. So let's take a look at an example. Consider a 20-year bond with 7% coupon. If discount rate is 6% annually, right? So find the price of the bond. But from these initial conditions already, from these initial conditions alone, you can already tell one thing. Is this going to be a premium bond or discount bond? Can anyone tell me? Is this going to be a premium bond or discount bond? So now, Chris, are you there? Chris is not probably there. George, are you there? George, Jacob, are you there? Jacob, are you there? Tristan,
I'm here, Professor.
George, you're there. Good.
Yeah.
Tristan, you're there too.
Can you ask the question again?
Yeah. The question is, okay, this bond has 7% coupon rate, and the discount rate is 6%. So from these initial conditions alone, we can already tell if it's going to be a premium bond or discount bond. So which one is it going to be? Is it going to be a premium bond or discount bond?
I'm going to say discount bond.
And who is this?
Tristan.
And what about you, George? What do you think, George? Is it going to be a discount bond or a premium bond? George, your answer is? Okay, you don't have, all right. You don't have, okay, then, once I give you the answer, then you don't have any more opportunity. Tristan, I'm sorry, it's a premium bond. It's going to be a premium bond. Why and how? I've been telling you from topic one. One way already you can tell, one way you can tell whether it's going to be a premium bond or a discount bond is whether the coupon rate is greater than the discount rate or not.
Oh, yeah.
Yeah, right? If the now discount rate, I will call that yield, because yield is the discount rate. And again, I told you this example is an exception, because in this example, I said discount rate is 6%, but I told you the way it is going to be worded, there are three ways it is worded. one is the bond is priced to yield 6%. Way, comparable bonds or similar bonds are paying 6%. A third way is the prevailing market rate is 6%. Okay, so you will never see again this type of they will this type of wording. They will never give you like this. Okay, but anyway, if the coupon rate is greater than the discount rate or the yield, then it's going to be a premium bond. If it is less than the yield, it's going to be a discount bond, right? Meaning, it's going to sell below 1,000, but if it is premium, it's going to sell above 1,000, right? So it's already the Q. And then finding the price of this bond is easy. We find the, again, but then bond is on semi-annual cycle, remember? Semi-annual cycle. So the coupon, that's first of all, 20 years, that means 40 semesters. So our N will be 40. Coupon rate, 7%, so annual coupon interest is $70, but semi-annual coupon payment will be $35. Okay, and then discount rate is 6%. Semi-annually, it's going to be 3%. That's the the discount rate. Okay, using that, plugging that into this formula, we're going to get $1,115.57. Okay, and the formula looks quite complicated. No, this is another variant of this formula. It's just another variant of this formula. I don't like this because that's simply another way of writing this, but that makes it look more complicated. This is better, right? So we're gonna do this on Excel, right? After the break. It's now like 1:55, so it's a good time to take a break. We'll take a 10-minute break and come back at 2:05, okay? And then we will do that on Excel, okay? So let's take a 10-minute break, okay? A 10-minute break, everyone. All right, we're back. We're back. So now I want you to go to our topics folder and download this bond valuation.xls. Okay, the Excel file. Please download it and let me know when you're ready. Okay, if you download it, you will on the first page or first worksheet, you will have these problems. And I want you to, of course, clear all the highlighted cells. All the highlighted cells. Okay. All the highlighted cells. This one is also highlighted cell, actually. You should. Okay. Highlighted cell here. Now let's first go to row 7, row 8, row 7 and row 8, because this is exactly our example, right? So everyone is here. I'll have to check.
Yeah.
Tristan, good. Antonio, are you on this? Are you on this file? Are you on that? Good. Aura, are you there too? Aura?
Wait, I think I clicked the wrong. Can you tell me what's it under again? The file name?
The bond valuation.xls. It says, the file extension tells us Excel file, right? And how about other people? Aura, are you there, Aura? Chris, are you there, Chris?
Yeah, Professor.
Okay, you have this file now. You have it in front of you. Okay, good, Aura. Chris, you have it in front of you.
Yes, Professor.
Good. George, do you have this file in front of you?
Yes.
Okay. Jacob, do you have it in front of you, Jacob?
Yeah.
Okay, good. Yosahani, do you have this file in front of you?
Yes.
Yosahani?
Yes,
Okay, good. All righty. And and as I said, you need to delete all the highlighted cells and go to row 8, right? Go to row 8. So this is, our example. Face value 1,000, coupon rate 7%, coupon rate 7%. So of course, compounding frequencies too, because bond is on semi-annual. And this payment, actually, it's given, but let's do this. It's not. It shouldn't be given, right? It should be like something you can solve for. Highlight is actually lighter, I think. Should be. Yeah, it's not a difficult thing. Because all of these, first of all, coupon payment. That's coupon payment. And annually $70. How do we know? Well, we know because the coupon rate is 7%. What you need to do is just face value times coupon rate. And then you divide it by N, right? Then, it's going to give you $35. It will have to give you $35. And then T is 20 years, and actual number of compounding. There'll be 40 of them because, it's M times T, right? 40. And then R, the periodic rate. APR is the discount rate. That's the another name for that is yield. But for now, let's, I'm using the label APR because that's annual, right? Sometimes I use YTM, yield to maturity. Okay. So then periodic rate is 6% divided by 2. So that's going to be 3%. Now let's find the present value of the bond. Okay. That's bond price. Then first we find the present value of all the annuities. All the annuities are basically, annuity formula, payment over R minus payment over open parenthesis R times 1 plus R close parenthesis and close another one. Because the whole denominator is being raised to 40, right? Okay, that's only the annuities, the coupon payments, plus now we need to find the present value of all those, present value of the face value, right? 1,000 divided by 1 plus R raised to N. Okay. So everyone is fine up to that point. Everyone is good up to that point.
Yes.
Okay, good. Then hit enter. Oh, something's not right. This cannot be. What happened?
The parentheses.
Let's see. D8, H8. Payment over R minus payment over 1 R times 1 plus R raised to N. Wait a minute. What's the yeah? Why did it come out as negative number? Plus A8, which is, yeah, face value. 1 plus H8. Oh, no. I've been doing, what did I do? Yeah, H8, correct, H8. 1 plus H8 raised to F8. And the parenthesis is correct. This must be a glitch. Cannot be like this. Let me try this again. But what did you get? Did you guys all get it right? You must have like 1150 something. Did anyone get 1100? Okay, let me see. This is initial data, original 7%. Okay, nothing wrong with that. Okay, where did it go wrong? payment over R minus payment over time plus R to N, close parenthesis. Oh, did I close parenthesis there? Huh? Something. I forgot probably to close the parenthesis there. And how come I didn't see that? Plus H8 is to N. Yep. I hit enter. Yeah. What did I? Probably I forgot to close the parenthesis there, but you know.
Yeah, that's what I was saying, the parentheses.
Oh, yeah, you mentioned that. Okay. Alrighty, so did everyone get this? How come nobody got this result? Okay, let's see. Someone typed in something I can't see. Okay, Aura said yes. All right. How about the other people? I mean, other than Aura, how about you, Antonio? Did you get the same result? How about you, Chris? What did you get? You guys are quite. You didn't get the same. George, did you get the same result? George? No? Jacob, you didn't get the same result? Tristan? Yosahani? Well, since all the other people are just quiet, I will have to assume that you got the same result. But if you didn't, please, just come forward. Don't be shy. So that confirmed. Yes, this is right. That's the result we got. And then, as I said, rational price of the bond, rational price. The way we did, the formula we use, that's the formula for rational price of the bond. Rational meaning this is the fair value. This is what it should be. This is the intrinsic value. As opposed to the, as they say, the market is rational in the long run. In the long run. But in the short run, it is not. In the short run, there will be compared to the stock market, bond prices are relatively more rational. There are fewer ad hoc factors in the bond pricing than in the stock pricing. And in the stock market, in the short run, it's all crazy. It's all irrational, right? There's no reason for that kind of sell-off. I mean, last week it was a terrible disaster. Last week was like it was like a plunder. Let's see how it is today. Again, down market again. Down market again. Oh, goodness. They continue to. That was. I'm sorry. That was not updated. That was earlier before the market started. The market is rebounding. The market has rebounded since this morning, right? Oh yeah. Last week, sometimes it's not sometimes. Most of the times, the market is irrational in the short run. They just there's a sell-off, and the sell-off was triggered by some crazy action. Um, the sell-off was triggered by some irrational judgment. Um, there was no reason for the market to lose like 5% last week, but then so I don't know. This is crazy. But I didn't sell anything last week. You don't sell at, so I didn't sell. So I suffered 5%. But, the market is, because as far as I could see, there was no fundamental reason for the market to go down. It was all just like a herd mentality. You've heard about herd mentality, just like the herd of wild wild. I don't know if you ever saw that episode on like National Geographics. Wild wildebeest. In Africa. There's always one leader. If the one leader runs in one direction, the entire herd follows. And then even if they die, the leader just jumps off the cliff. They all just follow the leader. Why? Because they are animals. They don't have any reason, rationality. They just follow the herd. The leader jumps off the cliff. They all follow the suit, right? In a short run, market is like that. And then they realize, oh, we've done stupid things, or they realize this is the time to buy now because the price has fallen enough. Now think about it. Buying back the stocks that have the prices have fallen, whose prices have fallen. Why do they buy it back? It's because they think the price will go back up again. In other words, if the prices are going back up again, that means there are nothing wrong with the fundamentals of these companies. Fundamentals are good. They just thought the market overreacted, thinking that the prices were overpriced. These stocks were overpriced, so they sold before the price falls. But then, always if you're at the tail end, you will just, you will always be at the losing end. I mean, even if it was a bit overpriced, yeah, there will be some correction of the price, but as long as there's nothing wrong with the fundamentals of those companies, then the price is bound to go up, right? So then, after the massive sell-off last week, then they're all, on a rebound, right? This is, Dow Jones, right? This is Standard & Poor's. This is Nasdaq, Russell, right? Russell, and the others are foreign. This is Brazil, FTSE. That's British. This is French market. They call it CAC, and Le CAC. A German market. Hong Kong, Shanghai, South Korea, Japan, Australia. I put Australia on top because Australia is where the sun rises the first in the world, right? They are the most easterly country in the world. You might say, oh, isn't South America, North America, east of? Yes, but the date line, international date line, right? is somewhere in the Pacific, and Australia is the first country after the international date line. So the sun rises first in Australia and New Zealand, and Japan and Korea, and then China. And Japan and Korea are in the same time zone. Australia is 1 hour earlier. China 1 hour later than Japan and Korea, South Korea and Japan. So next problem. Oh no, it's so. So we got that right, and then here, we're trying to find yield, right? But we will have to do that later because that's a different example. But let's think about this. The price is already given. We're going to find, this is also finding yield, internal rate of return. But to do this problem, right? Again, we need to use rate command. Actually, the highlight is changed. I should put it like this. And another one was finding n. So let's do this one. Yield to maturity is the discount rate, right? APR. But actually, we know it's half your rate, right? So we need to find the half your rate, the periodic rate. And this rate is called also mathematically internal rate of return. In other words, this is R, right? But why is it called internal rate of return? That's something I'm going to have to explain later. But you remember this example? In the price quotation, CIT group, 7% coupon rate. The current market price at time 0 is 91.735, and I told you this is the percentage, not the dollar price. So the dollar price will be $917.35. Okay, given the price, let's find what is the and so can you find what is the yield? Okay, and the yield information is given here. So let's see if we can find it by formula, and if it is this. So we will do that. So here, we will have to use the rate command because remember in annuities we can there is no unique single of answer, no unique single formula. No unique single formula for finding rate in case of annuity. So we have to use rate formula for Excel. And then, well, how do we know time left? And I told you, well, I actually found this by solving it, right? By solving it, solving for n. By solving for n, I found it because yield was given, right? Annual yield was given, right? So based on that, remember, based on, where is it? Based on this yield information, I told you, I could trace it back to 2010, right? And how? So let's do this first. So to find n, right? First, yeah, we divide yield, which is the discount rate, right? We divide it by 2, then you will get 4.42. And current market price of the bond is given 917.35. It's already given. So we can find n. And then you might wonder why then, the parenthesis. And I told you parenthesis is one way to represent cash outflow. I mean, 3 ways to represent cash outflow: parenthesis, or red font, or minus sign. Okay, so here it's red font and parenthesis, so that's cash outflow. Of course, it has to be. We need to express the cash outflow as negative to use Excel's built-in function, right? To use Excel's built-in function. So that's why and then the price of the bond, market price of the bond, is what you have to pay, right? If you want to buy this bond, you have to pay the market price. So paying market price, so that's cash outflow. And based on that, we can use a formula for n, but if you use formula for n, it doesn't have to be, what I'm talking about is, natural log of something, natural log of something divided by natural log of 1 plus r. We're not gonna, that's the formula. And if you are using that formula, we don't need to express cash outflow as negative, but we're gonna use Excel's n function, n period function. So then we need to express cash outflow as negative. So therefore, you go to functions, okay, go to financial, and scroll down until you find n period. N, okay, n number of periods. So give it what it's asking for. Rate, that's the rate. Payment, this is the payment, right? And then present value, this is the present value. Okay, future value, right? Since present value is already negative, I don't have to put a minus sign, but if this is not negative, I will have to make this, I'll have to add a minus sign. Okay, type, you don't need to enter type. Once again, this type is whether it is ordinary annuity or annuity due. Well, bonds are, ordinary annuity, because you don't, you get the interest at the end of the, year, or at the end of the first semester. So you leave it blank, and you got something here already. Hit OK. That's 11.71 semesters. Then how do you convert it into years? Just divide it by 2, right? 5.86, right? 5.86 years. That's why I said this is why I could tell the examples were taken around 2010. Because if that's the case, then we know the maturity is May of 2016, right? Then time 0 will be this minus this, right? But again, then I'll have to multiply it by 365. Why? Because uh, the calendar dates, Excel's calendar dates are based on, days, number of days. So I'll have to subtract 5, if it is 6 years, 6 years times 365 from May 2016. If I do that, hit OK, it comes to June of 2010. That's why I said this example was taken sometime around 2010, right? Okay, did everyone get this?
Yes.
Okay, good. Okay, then knowing that, let's go to, and it's almost 2:40, but let's just finish up this one. Okay, since we know, then we can let's confirm if this will give us the same yield to maturity, and of course I'll make it equal to this. I will need to know 2 decimal places, and then okay, then knowing that, let's use rate command, Excel's rate command. So go to rate. PR, where is R, rate, hit OK. End periods, there you go. Payment, there you go. Present value, there you go. Future value, there you go. Hit OK. Exactly the same thing. Of course, then annual rate, we should get the same thing. It's because it's this times this. Okay. That's rounding. You might say, oh, that's not the same thing. Oh, of course it's the same thing. It's just a matter of rounding. If you increase the decimal, then it's the same number, right? All right. This way, we could find, rate and n. Okay. So if you're good up to this point, right? Any questions? Any questions so far? Any questions?
I understand everything. I have a question, but it's not related to the class. Well, kind of.
Yeah,
I don't know.
you can go ahead.
Yeah, so what is the best option for a student to save money? Or which savings account is the best type of savings account for a student?
Oh, which savings account? Look, I wouldn't, with today's interest rate, there is no savings account that will be good for anybody. Think about it. They pay barely, I know for my savings account, I have Citi and I have Chase. My savings account pay only like 0.8% a year. That's clearly not. So I'm telling you, don't use, CDs, CDs will these days won't pay that much, but at least, it's risk free. Uh, Still, it will pay more than 0.8% a year. Some CDs may pay 1.25, 1.5, but still that's better than saving. CDs are basically savings contract, right? You just can't withdraw money during but they have like 1 year, 2 years, or 1.5 year CDs. Get to a CD. I mean, buy a CD. You can put like $5,000 $10,000. But if you have like, $5,000, open a CD account. Okay, it doesn't matter whether you're a student or not. Um,
Okay.
some banks may advertise we have, some savings account for students, but their interest rate won't be any better than 0.8% a year. Okay, so open a CD. All right.
Okay. And also,
Okay.
the final is at this Friday, right?
Yeah, starting this Friday.
Okay, it's going to be about all of the chapters that we have seen, or it's just the
No,
last
no, no,
chapters?
no, no. Since after the quiz too. Okay.
Oh, okay. Okay, great.
All right. All
Mm-hmm.
righty. All
Thank
righty.
you.
So if there's okay, have a great afternoon, and I will stop. If there are no more questions, I'll stop sharing, stop recording, and sign out.